Hi all, welcome to Sand Compounding. Diversification of asset and asset allocation forms a significant role in the process of investing. It's often discussed and people get confused whether to diversify too much into multiple asset types within a portfolio. Should we invest in 40, 50 stocks? Should we put in 2 to 3 funds? How much should we concentrate? How much should we diversify? So here is a session I have created to understand the process of investing from a prism of diversification, how much to diversify, and what is the apt level of diversification. So diversification to de-risk does not mean to putting all the investments across 1,000 stocks and funds and real estates and gold. That's not what we mean. It's to find the optimum balance which is comfortable for you as an investor. If the number of stocks in a portfolio is like say 5 or 10, and it makes us comfortable put like 5 to 10 percentage of distribution across 20 stocks or 10 stocks, that is the way of diversifying and de-risking. At the same time, on the other hand, it's not a good idea to concentrate too much, like putting all the money between just one or two stocks. That could, however good the business is, however good the fundamentals are, there could be unforeseen circumstances that could arise and disrupt the wealth that we created altogether. So preserving capital is very important. So finding a balance somewhere like between 5 to 10 or 15 stocks in a portfolio makes a good sense. And asset allocation is another important factor. That means as diversifying between assets, like one or two assets to have is a great idea, like equity and real estate or equity and bonds, so that when market cycle turn around, it's a good, we could get some liquidity to put cash in the downtime and get advantage of the market fall and the prices being available cheap. Now, is diversification really required for stock pickers? Well, that is a question to be answered. Yes, the diversification is required, but how much is a question. What is comfortable for the investors is a answer. Apparently there is no point in diversifying beyond a certain limit. Where people go and invest in 3 to 4 funds, where each fund itself will be invested in 40, 50 stocks. That is kind of lunacy. So it's a good idea to find 1 or 2 good funds and stick to that, or have 10 to 12 or 15 stocks, which makes an ideal diversification for a portfolio. And if it's even if it is the investor is a seasoned stock picker, there is a need to diversify a bit, but at the same time, concentrated investing like 5 stocks or 10 stocks in a portfolio can really give higher returns than the diversified portfolio, which is obvious, right? I mean, if the concentrated portfolio is known to, and based on multiple researches, it is known to give very high returns when things go right. But at the same time, when things go wrong, it can really take away the capital, and that is also not so good. Now, Warren Buffett has written on concentration, and Warren Buffett and Charlie Munger are strong propagators of concentrated investing, and Lowell Simpson in Geico also was a concentrated investor whose story was written in this book called Concentrated Investing, written by Tobias. And this is a very interesting book where they have dealt into different type of asset allocators. I mean, different type of investors who have concentrated portfolios and who have successfully managed to do concentrated investing. Now, Warren Buffett has famously said in a business school talk, where he said, "I could improve the ultimate financial welfare by giving you a ticket, and there are only 20 slots in it. And if we had, each investment that we do, we close a punch on the punch card, then all we make in lifetime is only 20 stock purchases." So that is the level of concentration and thorough analysis that Warren Buffett is suggesting. And the most important factor here is, when it is concentrated investing, an investor goes through thorough analysis, much in deep, because they have to ensure that the select few bets they're taking really will play the investment returns for them. I mean, if the analysis goes wrong, even a little bit here or there, that could erode the wealth that the investors created. So concentrated investors are typically people who do a lot of thorough analysis, understand the business completely, ensure there is a good competitive advantage, and they put in multiple checklists, checks and balances before they invest, and they allocate significantly large portion of their money into select few stocks. Whereas diversified investors are typically less analysis oriented. They can take chances by going with 20 stocks. Even one blows goes up, it's like 5% of the portfolio, but the others will outdo for the losses. So this book is a good read to understand the concept of concentrated investing and how elite successful investors have done so. Again, as we discussed, concentrated investing is not for all. So professional, for non-professional retail investors like us, it is always recommended to follow index ETF, which is a broad market reflector and a safe way to benefit from the equity-oriented dollar cost averaging and the returns from the equity. Mutual funds also is a good idea, where they get based on the good history of returns and fund analysis. We could go and talk to the portfolio manager or financial manager and understand which funds to choose, and that could include multiple different asset types also. And the most often investors tend to be impacted by the recency bias and over allocate in their investments to the sector or markets or funds that has outperformed in the recent past, which is often a big mistake. Usually, if you notice, the funds that has outperformed the last 3-4 years might underperform the next 4 years, and I mean multiple reasons: mean reversion, the cycles, the industries they invested in, etc. So it's a good idea to go with much longer term history when we do the fund analysis to understand the returns and the fund manager performance. Now finally, there is no prescribed number of stocks or allocation when constructing a portfolio. There are investors like Peter Lynch, who had thousands of stocks, and Fidelity Fund, and who compounded at 29% over 13 years. That is significantly higher than many of the concentrated investors. And there are concentrated investors like Charlie Munger and Warren Buffett in the initial days, and Lau Simpson, Lee Lu. There are many investors who have done concentrated bets. Now finally, to conclude, concentrated investing of 8 to 10 stocks will give better returns, higher returns than the chosen diversified portfolio of 30 plus or 20 plus stocks. This has been proven through many research papers, and one needs to consult with the financial advisor before taking decision on the portfolio construction. So that brings us to the end of this session. Hope it was helpful.